Thanks very much, Kamal. Thanks for the kind introduction, and most importantly, thanks for filling up the room quite nicely again. Usually after the first coffee break, you lose some people. So what we try to do is obviously to make it as interesting and entertaining for you to the extent that we talk about commodities, not probably at the very end, in the way where we believe you should invest. It's rather the general question of did commodities over the last couple of years lose the initial glamour of why people invested, and myself being responsible for $1 billion in hedge fund allocation for German institutional clients, but the firm as a whole, Feri Trust, runs 20 billion euros in discretionary assets, of which a couple of 100 million are in long-only mandates. And just recently we had a lot of clients coming up and say, do we need to invest into commodities? Talking about correlation, talking about other risky assets, etc., etc. So what we will do today, and I'm very happy to have 4 distinguished panelists with me, and they're going to introduce themselves in a minute. We're going to talk about in general and then touch on a couple of underlying topics as well. But I would suggest that everybody introduces briefly themselves. Nick, you want to start?
Yes, hi. I'm Nick Koutsoftas with Cohen and Steers. We run Cohen and Steers is a real asset firm based in New York City. Liquid real asset investments. We have about 48 billion under management, primarily in listed property, infrastructure, commodities, natural resource equities. I run the commodities portfolio. It's an active, fundamentally based strategy, and as Kamal mentioned, myself and the team has been there 6 months.
Thanks, man. Good day. Name's Greg Smith, commodity trader, based in both Australia and Singapore, managing long only or market neutral alpha, trying to capture contango backwardation, and been doing it for a while.
Sue Palmer. I'm institutional commodity sales at CIBC. CIBC is a Canadian bank. It's been around for over 140 years, and it's been in commodity derivatives for 20-odd plus years, mainly on the producer hedging side. And in the past 3 years, we've expanded our business to the institutional space, and we've had quite a bit of success, as Kamal noted, in raising index assets, and a lot of that is we're the only Canadian dealer trading commodity index at the moment, so it's been very great.
Hi, I'm Wayne Parker. I am a portfolio structure manager at FourWinds Capital Management. FourWinds are a commodity and natural resources specialist asset manager. We split into 3 groups. I work for the commodity funds group, and we've got 2 funds on that side. The one is a fund that tracks the alternative benchmark commodity index, which was formerly called the beige commodity index, which is a second generation active allocations index. And then our other strategy, as Kamal alluded to, is a agricultural only multi-manager, multi-strategy fund.
All right. Thanks very much for that. Wayne, why don't we stick with you with regards to, let's say, the overlaying topic, are commodities... Shall we invest in commodities? Do investors need to invest into commodities with regards to the diversifying effect? And if so, in which way should they? Just long only, hence passive, index, or even actively? What is your take? I just saw your piece out there. So there's a lot of academic research, in particular over the last few years, coming out saying correlations are too high to risky assets. What's your general take on that?
I think correlations have gone up over the last few years, which I mean everyone can attest to. But I think over the recent history, they have been going down. That's both into commodity and between commodities and other asset classes. And PERS communication, I think, covered that as well. So in terms of why should you invest in commodities, are they still a diversifying asset? I think so. I mean, it's also looking at, as an investor in commodities, you need to look at why you want to be invested in commodities. If you're looking for a flow of cash, so in terms of dividends, if you're looking at equities, you aren't going to get it out of commodities. You need to look at it in a different perspective. If you're looking as a pure diversify, yes, I still believe it does offer that.
All right. Sue, the clients you're talking to, are they in any way more hesitant than historically with regards to adding it, or saying it's 0.6 to equities or it's 0.5 to equities, and that's why I can invest into equities at a larger scale?
Yeah, I mean, we've been talking about doing strategies that are actually playing the correlation, when it peaked especially, but we've noticed that those strategies, in particular this year, in correlation coming back down, are performing less. What I would say is that, this is our third year of negative benchmark returns in the space, and I do a lot of work in terms of flows in and out of the space. And one of the things that I think is very notable is that flows in long index have been flat on the year, and inflows last year. So despite negative returns, we still see money coming into the asset class. And I think that's because people are very more strategic and long-term in nature. When they do invest in long index exposure, it's because they're looking for the inflation hedge or the diversification, and they're looking not in a 3 or 4 year period of time where there's a dislocation, but that there's a real fundamental reason for those attributes.
Greg, as one of the elephants in this industry, the veterans, what's your take on not only investing and diversifying, but Sue already touched on a bit on flow. We will talk about flow in detail later, but just to spin that into certainly a comment as you've been a trader.
Well, what I've been finding over the last 6 months, interest is more intense based on geographical location, firstly, and the second thing is what their major issue is in that location. So when I come over here to Europe, there's still the concern about the euro and growth and demand. You go into Australia and they're more focused on China. You go to Japan and they're more concerned about inflation. And one of the things with commodities, and I think the general sentiment at the moment is very conducive for us getting close to a bottom. And there's investors out there that are actually pulling out because they've been in the last 5 years and had the breakdown drawdown. They weren't expecting that. Then there's others that have watched it go up, come down, and are saying, okay, these things are cyclical. Now's probably not a bad time to be looking at it. So even though there's less people than there were looking at it back in 08, 09, I think the ones that are looking at it now are looking at it very seriously, sophisticated, understand what they're getting in. And one of the things that I'm always keen to point out as looking for commodity converts, because I'm a zealot when it comes to the space, you all need them in your portfolio. It's how you do it. It's up to you. But one of the things to bear in mind that you make money when you have a supply shock. And you get the econometric view where they're looking at PPM numbers and all this sort of stuff and give you the sense that they know what's going on because they've got all this framework behind them, God bless them. Bottom line is supply shock, whether it's politically driven or whether it's weather driven. And one of the reasons why you want to be in commodities is that shock could actually impact other parts of your portfolio. So I'll just let that resonate for a while.
Which implies that you're still a big believer of diversifying effects of commodities and in general allocations.
Without a doubt. The bottom line is, if you don't believe that there's going to be more severe weather patterns impacting a growing area, either too much rain or not enough, don't invest in ags. If you believe the Middle East are going to get themselves sorted and going to be the banner of human rights and passiveness, don't invest in commodities. But if, like me, you know that you're extracting something we need where a region has fighting season, the logic and rationale suggests that at some point they're either going to hit a tanker in the Suez Canal, for example. Insurance rates will go ballistic. And then the cost of getting the oil to us is going to increase. And that's inflationary. But a lot of the stuff's not talked about because it hasn't happened, or the probability it won't happen. And yet I love it when the bankers get up and give us statistically this should never have happened. Well, it did, and it cost us. So you've got to be thinking about that in the commodity space.
All right. Nick. What's left?
What's left to say? The only thing I would say, and just to capture what Greg is talking about, I think though, I think we briefly touched on, active versus passive. And I know it's a popular debate and something that is going to be talked a lot about here and has been talked about already. But it's the more active strategies are going to capture the differences. I mean, weather impacts, crops in many different ways. Currencies impact, prices in many different ways. I mean, look at sugar prices versus the Brazilian real and the correlation there. So, it's not just, you still can't just say, let's invest in commodities as a bucket. I think you really need to be smart about it and, take a harder look at each specific commodity. And then just from a, investor perspective, we've also been seeing people getting involved in commodities in a more diversified fashion. So in, real asset type funds where commodities is maybe one sleeve of a diversified basket of real asset protection that might include natural resource equities, real estate, infrastructure, things like that as well.
Okay, as we talked about flow, and I would love to touch on that a bit. Talking about active, passive. Obviously, Chris Level, Clive shutting down, a couple of other commodity hedge funds shutting down. So people leaving the space a bit, throwing the towel, not really raising assets a lot. Greg, just coming back to you. Where do you see flow in general? Do you see market participants changing from the large shops to the boutique shops, prop desks kind of scaling down further? Where do you see flow? And we just learned this morning, I would not even say 70%, I would lift it up to 80% of volume in the commodity markets from hedge funds, because, we are invested in a couple of funds, they turn their book 25, 30 times a year. So that's a hell of a trading. So where do you see flow?
Well, history is littered with traders in the commodity space or in any space where they're leveraged long short. So because of the risk they're taking, you're going to have casualties. But the interesting thing, being a cynical old bugger, these blokes will shut down, come back as superstars, reinvent themselves, and the good thing is they don't have to adjust their high watermark. I've seen that happen a few times as well. I think in response to the other question was more on flow. I agree with this fella here. I think that there's more and more people looking at the commodity space now for a number of different reasons. And I think it's good that they are, and don't really have much more to add than that one at this stage.
Sue, with regards to flow, we briefly discussed this beforehand. Is there a shift of where flow comes from? Is it going to be more sticky because the active hands scale down, lose assets, and that's why it's rather a long-only place?
I think without a doubt there's been outflow in terms of spreads. And in particular, I really focus on index investment. So when we look at spread index investment, I estimate we've probably had 20 billion come out of that space on a year-to-date basis. And last year as well, we saw some inflows at the beginning of the year, outflows at the end of the year, so relatively flat. Spread index positions have been pretty crowded trade, and I think the alpha there has been, shall we say, squeezed out. So I think that there's been some repositioning. I think that doesn't mean that people don't continue to look for opportunities there, and maybe look for opportunities more in a dynamic fashion. So I would say that there's still interest there, but people are waiting for sort of when markets look good and timing. The long flow, I think, continues. I think but for totally different reasons. Long only, long term, very sticky money.
Wayne, just on flow again, and probably thinking about liquidity as well. Talking to a couple of managers every month, we got some feel that some managers are a bit in fear about liquidity dry out in some particular commodities. Is there anything you can comment on that? Is there anything you want to add with regards to your own experience within portfolio management?
I think, in terms of liquidity of actual commodities, where we actually lined up is we tend to be on the more liquid front end of the curve, so we don't see any issues on that side. In fact, especially with some of the smaller commodities, there has been liquidity improvements. How that happens moving ahead with changes in allocation, so be it money moving away or to indices, and what different types of indices are moving away from the front-end first-generation indices may have a play on that liquidity later on, but I think that still has to play out.
Okay. Just coming back on that inflation element, real asset approach, which we talked about, Nick, earlier before, and which just Greg jumped in on. I think this is something which is important. Just remembering two discussions I had last week with two large German institutional investors who have a long-only allocation, who are, on the other hand, close to throwing the towel just for the sake of not believing in the diversifying element, but the element which always brings them back to the table is it a real inflation hedge if we see inflation? I mean, we always discussed it, and my honest belief it's inflation expectation and not inflation itself. But is that something where investors might switch over with regards to the concept of investing into commodities, saying, okay, it might not be a diversifier anymore, but this is my tail risk hedge when it really hits the bottom and Bernanke goes too wild?
Yeah, it's a... You know, commodities have many portfolio benefits. The key with inflation is that it's a hedge against unexpected inflation. So it's the insurance policy in the portfolio, you know, if inflation, you know, rises faster than what's being discounted in your typical inflation-protected securities. So it's, you know, like we know, it's a 3 to 5% allocation of portfolio that's meant to act as insurance, to provide diversification, to act, you know, to protect against supply shocks, and to add a little benefit there when we have unexpected inflation. It might not come next week or next year, but you know, I think it's a whole separate debate on, you know, I mean, if you want to get into the U.S. politics, we can certainly do that. But the government's shut down, so we can't talk about that now. But I'll let
Greg is desperate to say.
I'll just give you the heads up on unexpected inflation. Unexpected inflation is the stuff that the economists aren't talking about that we all are. It's the unexpected inflation that actually drive the underlying commodity is the driver of the inflation, because you don't know what weather pattern's going to hit. You don't know what Middle East country supplying oil is going to implode, but the inflation that's unexpected is the underlying commodity that lifts inflation beyond where a lot of governments had actually pegged it or tried to control it. And history is littered with resource-based inflation.
Sue, any comment on that with regards to clients not only investing into commodities with regards to diversification, but is that part of the discussion? Let's phrase it that way. Is it part of the discussion that clients say, okay, there might be a return, but it's also a tail risk hedge?
Yeah, absolutely. You know, in terms of inflation, we can look at historical properties of commodities with relationships with CPI. And what you'll find is, you know, oil and energy definitely have the strongest relationship. But the real problem we have is that we don't have a good data set, because the last time there was inflation, we all were functioning in different markets. And markets have certainly evolved since the early 80s, and the type of players in the market are different. And certainly volume is much higher. So I think it's yet to be determined if inflation does hit us, if it does have the same properties as our statistical long-term analysis. But I think when you look at your options for hedging inflation, and you run the same statistical analysis among your options of different types of investments that have inflation hedging properties, you'll find that for sure your energy-focused futures exposure is probably going to have that best relationship. So I think to be determined, you know, if we really get into that scenario, is it actually going to play out? I don't know the answer. I hope it does, but we certainly, from a statistical point of view, find that it has the best relationship.
Wait.
I think that's more like a question to the rest of the panel. It's obviously we're talking about inflation or commodity investment being a hedge to inflation. Do you perceive an active commodity portfolio, be it long, short, or market neutral, is that still providing the same hedge?
Well, I think it is more than, you know, just an index passive approach, because I mean, Sue's approaches are index that are, you know, based on historical simulation, and they work until they don't work. So I think you need to be somewhat active, or, you know, not react to outflows because, you know, the short forward, you know, the short front end long 3-month forward, you know, stops working and then the flows come out. That's, you know, I think you need to be a little more active, because the inflation protection is inherent in what you're doing, as long as you strive to keep the beta to the, so you can be active and you can keep a high beta to your benchmark and still preserve the diversification benefits, but at the same time give yourselves enough flexibility to generate some alpha as well.
I mean, the discussions which we have with clients when it comes to inflation hedge is that we always drill down to the particular commodity, because looking at statistical analysis, and we do a lot of quant stuff in that regard, it differs from commodity to commodity, the kind of quantitative link to inflation. But in general, I totally agree that it is an inflation hedge. Touching on another topic which people talked about this morning, China. Obviously, how important is China, etc. And Greg already touched on that supply shock, which I think is an ever more important topic. On the other hand, obviously, we have different supply-demand patterns in all these kind of commodities. Just talking about copper, where the market is still seeing 14% growth in infrastructure installments for electricity in China, where the government is aiming for 5%. So is this going to be a less demand effect on copper? Wayne, how do you see this kind of China being the almighty moving commodity prices up and down?
I think they still have a big influence. Obviously, China's GDP has dropped from its highs that we were seeing, but in the same respect, their population growth has grown. So it's a lower GDP over more people. So it is something to bear in mind. The demand is still there. It's not as high as it was. But I think they still have a major plan. They are still the biggest driver of demand globally.
Greg?
Well, you've only got to look at the statistics with the amount of cars that are being sold in China. And what blows me away is we're talking 20, 30 million cars needing more tyres and using aluminium. And I think the China story in the commodity portfolio is the base metals, I agree. I think your gold is more of a global currency, because like it or not, you can break it down, melt it, join it, won't corrode, and we've been using it since we crawled out of the caves. And as we continue to move forward, I get more and more concerned about the fiat system. US is a classic example, EU is a classic example. The supply shock, though, is in energy and food. And when you do your stats and your numbers, and we all have access to this lovely data now that as a young bloke I didn't have, but what we do see now is that the impact is a function of your disposable income. Now, what kicked off the Arab Spring was not only the brutality, but a 50% increase in food. We don't feel it as much in the West because it's still a small component of our disposable income. But however, if the shock is big enough, we will feel it, and there'll be a lot more people out there going hungry. Now, what I think also, because I'd like to be a little bit maybe controversial politically, because, I come from the middle of Australia and we tend to tell it how we think it is. You've got politicians now coming into the commodity space. First example was you had politicians in Brussels determining how you should build a portfolio in use it, which is flawed, because what does a politician know about it, firstly? Second thing is, you've now got a strong push from the left-wing Greens not to speculate in agriculture. Now, that is also flawed. Firstly, those that participate in that will not be able to hedge their portfolio against the cost of living and are going to be very pissed off because they're paying more for their bread and cornflakes versus a retiree that actually had it hedged. So I think what we've got to deal with going forward is understand politicians might be trying to do the right thing, but they're not. Long term, it's not going to work out.
All right, just spinning back to China briefly, Nick, and then the last and final topic is, and Greg was jumping the queue, is certainly on regulation and how high frequency trading is impacted. But Nick, on China, do you have any particular opinion?
Yeah, I mean, all I would say is that China's, doesn't concern me. We raised the issue of GDP. China's GDP was 1.7 trillion in 2003. It's estimated to be 9 trillion in 2013. It grew 11 to 12% 10 years ago. Even if it were to grow 6%, 2013 or 2014, that's still a lot of consumption in China. And even if they're not exporting as much and the focus is on internal consumption, it just means it's a shift from base metals or met coal or iron ore to energy and agriculture. So, again, it's not just, we have to stop thinking about commodities as just one big bucket. There's hundreds of different commodities, in the world. I mean, only 30 of them are liquid, but, we have to just think about each one individually.
On high-frequency trading and algo trading, or including regulation. Let's spin this together, because obviously, being from Germany, where we love to regulate everything, and we are certainly at the forefront if there's a law which we can extend to regulate it even better. So high-frequency trading is certainly a discussion in the politician kind of agenda. But Sue, what do you see in terms of, let's say, liquidity being impacted, algo trades? I just recently had a meeting in New York with a large investment bank, can't drop the name, where apparently they are not using their algos anymore. They use random trades because they are in fear of being sniffed up by the hedge funds, using algos to sniff out other algos. What's your take on that?
I think this is going to be a real hot topic for going forward. What's the impact? We know that there is increasingly numbers of high-frequency traders in commodity markets. The data is really not available in terms of trying to figure out where their impact is. And even if you might have some data, it's computationally extremely expensive and tiresome to analyze the data, because you're talking about tick-by-tick data. So it's not something that we've looked at yet, because we just don't have the data or the ability to look at it. But I think that people will continue to find ways of looking at the data. And in terms of liquidity, I think that there's not just high-frequency traders, but we've, the recent impact of Dodd-Frank in terms of clearing mandates and positions being 15 minutes after a trade, things become transparency has had a double effect in terms of, one, that might make a market maker more aggressive in pricing, but it also might make a market maker less aggressive in pricing, because now there's maybe less willingness to take the risk. And now a dealer used to have hours or days to be able to unwind that kind of risk. They have a 15-minute window now, so that might be could potentially widen bid-offer spreads in certain types of areas.
Just as you touch on bid-offer spreads, or let's say costs in general, do you have any kind of input on that, Wayne, with regards to trading in those market warehouse risk, where people just rather don't take a position but clear their positions quite quickly, just for avoiding of being snapped up? I really heard stories where people they don't want to be on either side. They just want to be flat because they are in fear of being sniffed up that they hold a position.
I think there's also been a lot of funds around historically that have been sniffed out as being very long a certain commodity and then being closed out by the market. So I think it is something that traders are a lot more aware of now. So and there's also with some of the rules that have come in for the US banks especially, or the banks in general, withholding physical or dealing in physical. But will that have an effect of spreads and futures? Possibly, but I think with more going back to high frequency side of it, if by putting regulation on high frequency with how often they can trade, that will probably have more of an effect on the widening of the spread than anything else.
Nick, just on regulation in general and high-frequency trading, have you seen any impact from a regulator? Greg touched on Brussels. Everybody feels like being in the game of regulating the commodity markets. Let it be for the food, and everybody is poor and specs shouldn't trade in it. But do you see market participants being impacted by that already and changing their behavior?
Potentially, depending on what type of vehicle or structure you're using. High frequency to me is 7 trades a week. So that's I don't know these other types of high frequency. And as far as liquidity, unless you're trading greasy wool or azuki beans, we're dealing in some fairly liquid markets. So the size of the overall market has to get pretty big to for me to see any impact, but so it's hard for me to say.
Good. Time is running very quickly, and as always, towards the very end, before we open up for questions from the audience, basically, in a nutshell, what do you guys believe is the hot topic next year? If you want to drop a particular commodity which you believe will have a certain move, let it be long or short, let me know. Otherwise, I'm rather interested in your opinion on, is active investing better, more valuable in terms of capturing some alpha? Is there any alpha left, or is it just pure out index passive investment? Nick, you want to start? Put it in a nutshell.
Yeah, you have to go active. I think you're doing yourself a disservice by going index passive only. It sounds good this year because of a couple of curves that are in backwardation, but over the past 20 years, you break down the total returns. Only 5 of those 20 years have given you a positive roll. So, don't get too caught up in the backwardation. Won't last that long.
I hope everyone understands where I come from. What you're trying to identify is where's the next supply shock. And it might be sugar, which you've seen, or it might be wheat, or it might be cocoa. So you want to try to skew your portfolio there, as opposed to having it either equally weighted or backwardated weighted, is where I come from.
I certainly think there's a place for passive in a portfolio, but that doesn't mean that you should just leave it alone and not try to respond to current environment and add either tactical position overlays on it. So that's what we tend to see our clients do. They have a passive exposure that sits there, and they're frequently positioning around that benchmark. So I think that, of course, you don't want to just forget about it and not be relevant to what the current environment is.
I agree with Greg very much in terms of trying to identify what the next supply shock is. This year has been very nice. In fact, there's been barely any supply shocks. I mean, there's been an oversupply of grains globally, but in terms of actual weather supply shocks, there's barely been any droughts, barely been any floods. There's barely been any tropical storms hitting the US. It's been quite a quiet year in terms of that. So I think next year it could be back to normal and seeing increasing weather shocks at least. In terms of portfolio construction, I wouldn't say active only or 100% passive only. I would say probably a mixture of the two. So rather than going 100% long only, commodities exhibit mean reversions. Anything you're making on the upside, you're getting back on the downside. So rather doing a mixture of the two, so getting some form of beta, be it with a protection built in either via active management or via a risk reduction.
If you want to hear my opinion, being invested with $100 million in commodity hedge funds, I'm certainly having the opinion that an active approach, let it be long or short, and even a blend of equities with general commodities, let it be futures or options, makes sense. But most of the investments which we are in favor of in the commodity space are managers who blend equity investments, mining companies, etc., with a general commodity approach. But having said that, I would love to open up for a question from the audience, if there are any, and I hope they are, if possible, controversial to what we've said.
Yes, the name is Antonio Urbano. The company is Vintage Partnership. We have a particular interest in agriculture, specifically viticulture. We are an Italian specialist wine fund. And I have to say, Greg, I share every view. And I'm Italian, but I was born and brought up and raised in Yorkshire. And we too, we say it as we see it. And politicians haven't got a clue. They don't have a Scooby. We are involved actively, myself and my partner Roberto, speaking to producers, meeting producers, and to government agencies and government representatives. They just don't have a clue. And they are running around like headless chickens, and they are still deciding and making and taking decisions, and that is what is dangerous. I think your view, I share every part of it, and I'm particularly interested, Greg, in that I too believe that you're going to make a lot of money when supply shocks come around, and we firmly believe that there are a few around the corner. We've identified where we believe a supply shock is going to be, and there's going to be a big turn there. It's in food, and we share your view. And Greg, you're a straight talker. I love it. I like it, and I love what you've said. Where is it going to be, in your view, in the food sector along that chain? I mean, where do you think it's going to come?
Well, I appreciate that, mate, and I can't say anything bad about you because you make wine. So, you know, I'm envious. I reckon you got a pretty good job there in Italy, I'll tell you. What are you doing here?
We start tasting at 8 o'clock in the morning,
Right,
and we finish at midnight.
I think one of the issues you've got to look at, and I think it's a good question, is two examples, corn and sugar. Corn can either be a food or a fuel. Sugar can be a sweetener or a fuel. So you've got an issue there. If you do have increasing oil prices, people are going to be eating less corn because they'll be putting it into fuel because they'll actually get more for it. And this is what the politicians don't see when they say, oh, you've got to speculate against that. Well, what about when the US mandates 1 billion litres as opposed to 780 now? There's people out there that are going to be eating less corn because of the US policy. Nothing to do with speculators. So I think the tie-up with energy and food is one to watch. And the other one is with food, it's a lot more sensitive to society than fuel. You know, if we have to turn the lights off early or we have a blackout, it's a pain in the arse. But when you haven't eaten, or you go into Tesco and there is no bread there, that is the issue. That is the issue. And I was in Hong Kong a number of years ago when they had this big Chinese fella with a sawn-off shotgun standing out the front making sure they only took one bag of rice. So I've actually seen what happens. And it can happen anywhere. So food's the one to watch because it'll impact on everything else.
Thanks, Greg. Any additional question?
I've got one.
Come on.
Mark, it's actually a question for you on the hedge fund side. So we've had a lot of discussion about active and passive. Now, on the active side, the reality is the commodities, as we see them becoming more differentiated, are extremely idiosyncratic. Do you think it's realistic a manager can genuinely add value across 24 commodities? And do you think that we now see the rise, and we've already seen some sign, but the growing emergence of individual commodity fund traders who have a specific information advantage in, whether it be cocoa for a London hedge fund, or whether it be base metals for another London metals fund, and so on? Is that, do you think, in a world where things become more active, you need to go that way?
Straight, honest answer, no. The way we allocate portfolios, and we don't build a fund-to-fund which is then distributed in any way, we build the portfolios for individual clients who either understand commodities or trust us. The way we build it is we obviously look at the individual manager, which commodities they trade, let it be long or short. So we are invested in an ag manager who only trades ag. We are invested in a base metal manager, and that's when we blend the portfolio. Obviously, we don't know. I mean, we have an opinion where we think certain commodities might move to, but it's up to them because that's why we invest into them. But the way we structure these portfolios, and when I say multi-strat, it's, for example, I'm thinking about one client where we have 6 managers more or less complementary to each other. So to answer your question, no, I don't think that there is a person, not even a team, who's able to more or less analyze 24 commodities. Because at the end of the day, as Sue said, I mean, you need the data. You need to have proper data. If you step into the algo trading, you need proper data, you need technology, and you need risk management. So every commodity trades differently. I mean, you have gap risk in some commodities, etc., etc. So, no, we allocate portfolios in the way that we give money to managers in a certain space within commodities, and then we blend it with others to make it a multi-strat portfolio.
Can I say something to that, Kamal? One of the downsides to that one, mate, is if you get a specialist ags trader or a specialist energy trader, over time, as they get bigger, they can evolve into an amaranth. And then you've got the rest of us generalists like me finding out, oh, okay, so I'm putting the bid in natural gas on one shop. Oh, or I'm putting the bid in corn on one shop. So if they go down that path, they're always going to be small by default because otherwise they're going to get hammered. So I think, that's one of the problems with trying to look for a specialist. If you find them and they agree that they're not going to get bigger than X, well then not a bad strategy.
I think Nick wants to comment, but there was also a question from a gentleman in the corner.
Yeah, I just want to say, I mean, the two questions I would ask is, one, how much does it cost to put together a strategy of multiple strategists, paying hedge fund type fees? And I think you'll then have to you ask the investor, what are they looking for? Are they looking for commodities for the beta or just the alpha? If it's just the alpha, then, you can do it that way and just prepare, I think, to pay hedge fund type fees.
Can we take one more? Last one. All right. I saw one arm somewhere in the corner, which is not. No, it's up again. Okay.
Thank you. Michelle Butler, it was commented that you can make a lot of money from supply shocks. Could you comment on how you can lose a lot of money from supply shocks? And you can't predict shocks or they wouldn't be called a shock. So if you could just please comment on how you manage that in a portfolio.
Yes. I think I'll kick off on that. That's a good question. Firstly, the supply shock it runs further, faster than expected. It's not something that happens overnight. And when the market realises it tends to be in 3 stages till you hit demand disruption. So that's the first thing with the supply shock. They're inevitable, they're repeatable, they're identifiable, they're unpleasant, but how are you trying to capture that? Well, effectively, you've got an understanding of your inventory levels versus the seasonalities, and the planets line up, the price starts moving because underlying can't get it, and then there's a realisation in the market that, we actually need this now. Markets move into backwardation and they start to move. The issue, how to lose money, is you short commodities. That's how you lose money. Because when you short a commodity, it's like a granted call, right? First thing is, commodities aren't going to zero. Okay, they've got intrinsic value. The second thing is, the markets can go limit up or limit down, but when you are short a commodity, in a supply shock, that is when you lose your money. Then the other thing after the supply shock is how much are you actually going to take off the table, is the question I'm more concerned about, because I don't like to short commodities in case there is a supply shock.
There might be one example where supply shock could be negative in that look at natural gas production in the United States. It's not a shock, but it's certainly the amount of natural gas production in the U.S. I think has shocked a lot of people. It's something that took some time, but has put prices down. It's a rare example of where the shock was negative, too much production.
Thanks for that. Sue, gentlemen, I think we're done, and I'm handing over to Kamal. Thank you very much.
If you could please thank the panelists.